Hello and welcome to Lecture 13. We're going to be discussing payments among nations. This comes from chapter 16 of your book. So first we're going to talk a little bit about the accounting principles and how we look at payments amongst nations. The balance of payments, or BOP, is an accounting of a country's international transactions for a particular time period. So what we're going to be discussing in this lecture is how we account for the financial side of international trade. Up to this point, we've been discussing trade amongst nations, where we've been talking about goods and services only. We haven't been talking about money and how the financial transactions take place. Now, as we look at payments among nations, how do nations pay for those goods and services, and what is the balance between these nations? So the balance of payments is an accounting of a country's international transactions for a particular time period. Double entry accounting is used. Each transaction has two items, so there are debits and credits. Hopefully you've all taken an accounting class up to this point. An item that would cause funds or money to flow into a country is a credit, recorded as a positive value. So the way you could think of this, if you know anything about accounting, when a firm accounts for revenue coming into a business, the normal balance of a revenue account is a credit balance. So if the money flowing into a country is a credit, that's a good thing. An item that would cause funds or money to flow out is a debit, recorded as a negative value. So similar with a company, if a company spends money, let's say they purchase some supplies, that will be accounted for as a debit in that expense account. And so here we've got credits and debits. For a category of items, a balance that is positive is a surplus, one that is negative is a deficit. So we're using positives and negative values to represent the surplus and deficit in the balance of payment. So a country's balance of payments, we can look at it from a few different standpoints. One is what we call the current account, and we'll discuss what each of these mean here in just a second. There's the financial account. We'll look at the net change in official international reserves and net errors and omissions. So these make up a country's balance of payments. So let's start with current account. So with the current account, we're looking at exports and imports of goods. So this is merchandise, are all flows of raw materials and manufactured goods out of and into the country. So manufactured goods and raw materials coming in and out of a country. Also, we've got the exports and imports of services, which include tourism, transportation, insurance, education, telecommunications, and professional services. So we've got goods and services that are both being exported and imported. We have income flows, and these are mainly receipts and payments, interest, dividends, other claims on profits to holders of foreign financial assets. So those are income flows. Then we've got unilateral transfers. And these are gifts, such as governmental foreign aid and migrant remittances that the country receives and that the country makes. Okay, so these are unilateral transfers going one way, income flows, exports and imports of both goods and services. This makes up our current account. So current account balance is the net value of flows of goods, services, income, and unilateral transfers. So that's what makes up our current account balance. So the goods and services balance, which is just a portion of this, is somewhat narrower. The number is obtained by adding up exports and imports of goods and services. The balance on goods and services measures the country's net exports, what is commonly called the trade balance. So if you're listening to the news, and if they're using these terms correctly, they will talk about maybe the trade balance. In that case, they're looking at the balance in goods and services. So that was the current account. Now let's talk about the financial account. Financial account balance is the net value of flows of financial assets and similar claims. So we're looking at credits first. These are funds that are flowing into the country. Remember, we talked about credits, thinking of it more like a revenue. These are positive items. So this could be where a foreign resident could increase their holding of a US financial asset. So maybe somebody in England is investing in a US stock, a bond, an IOU from a loan, something like that. So money is flowing into the US from a foreign resident, or a US resident could decrease her holding of a foreign asset, a stock, a bond, an IOU from a loan. So we could have somebody here in the US that owns a foreign asset and decides to sell it and repatriate those funds. So those are funds flowing into the country. On the other side, we have got debits, and this is funds flowing out of the country. They're considered negative items. This could be when foreign residents will decrease their holding of a US financial asset. So they're selling a US stock, bond, or an IOU from a loan and receiving the funds back in the foreign country. Or it could be a US resident increasing her holding of a foreign financial asset. And so somebody in the US is investing abroad. So the funds are flowing out of the US with debits into the US with the credits. So what about our BOP, our balance of payments? One of the terms that we need to be familiar with is the official international reserves. And these are money-like assets that are held by governments and that are recognized by governments as fully acceptable for payments between governments. So gold was used in the late 19th and early 20th century. Foreign exchange assets are used now. So we're talking about exchange of currency. So the official international reserve is money held by governments. We have also, as part of our balance of payments, a statistical discrepancy. And this is the net result of errors and omissions on both the credit and debit side. So if we don't quite balance, we know that there's going to be some sort of statistical discrepancy. So this is a bit of a plug number. For the US, much of the discrepancy is under measurement of private capital flows. So not having a full picture of funds that are private that are moving between nations. And so that would be our statistical discrepancy. So here is a look at the US balance of payments for 2013. This is in billions of dollars. You can see we start here with our current account. Then we have our financial account. This is excluding official international reserves, because down here we have our official reserves and then our statistical discrepancy. So you can see for the US in 2013, we exported 2.2 billion, sorry, this is 2.2 trillion in exports of goods and services. We imported 2.7 trillion goods and services, income received from foreigners, income paid to foreigners, and unilateral transfers, the net. So our current account balance is negative, which means more is flowing out than flowing in. Then we have our financial account, changes in US direct investment abroad, changes in foreign direct investment in the US, changes in US holding of foreign stocks and bonds, changes in foreign holdings of US stocks and bonds, changes in US loans to foreigners and other investments, and changes in foreign loans to the US and other investments. So remember, positive means funds are flowing in, negative means funds are flowing out. So there were more funds flowing out in US direct investment abroad, more funds flowing out in US holdings of foreign stocks and bonds. So, but on the financial account balance, that was positive. So that was a net inflow current account balance is a net outflow. Then we have our official international reserves. These are looking at changes in U.S. official holdings of foreign assets, okay, and then changes in foreign official holdings of U.S. assets. So in this case, we've got 287 billion flowing in. And then lastly, in order to balance, we've got a statistical discrepancy of 28. So some other things to look at are the other import balances. This is goods and services balance. This is the 475, and you can see that's just the difference between these two. And that's a much narrower view, as we discussed earlier. And then the overall balance is negative 287. So the overall balance means we had an overall net outflow of 287 billion for our balance of payments. So let's look at the broader picture, the macro meaning of the current account balance. So the country's current account balance must equal net foreign investment. The increase in the country's foreign financial assets minus the increase in the country's foreign financial liabilities. Okay, so country's current account balance must equal the net foreign investment. So that's both going in and coming out. So we can look at that as the country's foreign financial assets minus the increase in the country's foreign financial liabilities or debt. So if the country has a current account surplus, a positive number, then its foreign assets are growing faster than its foreign liabilities. The country's net foreign investment is positive. It is acting as a net lender to the rest of the world. So if, as it said, the current account is a surplus, that means we're borrowing less than we're lending to the rest of the world. If the country has a current account deficit, then its foreign liabilities are growing faster than its foreign assets. So we're borrowing more from foreign nations than we are investing in foreign nations. So the country's net foreign investment is therefore negative, is acting as a net borrower from the rest of the world. So now we're going to look at a few formulas for calculating the current account. The first one we discussed from the previous slide. Current account equals net foreign investment. IF is net foreign investment. The second one is current account equals S minus ID, where S equals national savings and the ID represents domestic real investment. CA equals Y minus E is the third, where Y equals domestic production or GDP, and E equals domestic expenditures, and those are considered to be equal to consumption plus domestic real investment plus government spending. So those are domestic expenditures. So according to number 2 up here, when a nation has a current account surplus, so the current account is greater than 0, that would mean that this S would have to be greater than the ID. So national savings is greater than domestic real investment. According to 3, when a nation has a current account surplus where the current account is greater than 0, then Y, domestic production, is greater than domestic expenditures, which of course is consumption, real investment, and government expenditures. So we're producing more than we are consuming as a nation, so our current account is growing at that point. So that's more from a macro meaning of the current account balance. Here we're going to see this chart. This ranges from, I believe, close to 1960 all the way through 1963 to 2013. So we've got 50 years of data here where it's showing the current account balance and goods and services balance for the US. Okay, so the black line is our current account balance. You can see We are in a deficit as a percentage of GDP. Our current account balance is negative. And the goods and services balance, remember, is a subset of the current account. And you can see it's moving very similarly. Again, we've got a negative amount or deficit in relation to our GDP. Next shows the current account balance and goods and services balance for Canada. This is over the same time period. And you can see Canada's stayed pretty close to zero. They've hovered right around zero. They had a positive goods and services balance and current account balance through the early 2000s, but we've seen that drop off again. And so we've got a negative current account balance in relation to GDP. Finally, this is looking at Japan, the same type of chart as we've seen in the previous two slides, where we're looking at the current account balance and goods and services balance over this 50-year period. And you can see for some time from the early 80s until just recently, the goods and services balance was high, above zero as a percentage of GDP. And the current account balance has remained above that level, but you can see this huge drop off of goods and services balance as in relation to GDP. So that could suggest that maybe they're importing now a lot more than they're exporting, whereas in these decades here, Japan was a huge exporter of goods and services. You think of automobiles and other manufactured items that were considered high quality. They've had a lot of competition from other parts of the world. So I'm sure there are other factors leading to this decline as well. Finally, Mexico. Over the same period, you can see they had a spike through the early 80s, dropped back down in the 90s, and we're back to the pre-80 level, where they're importing just a little bit more, or having a negative current account balance and goods and services balance over this time period. So the macro meaning of the overall balance. Overall balance should indicate whether a country's balance of payments has achieved an overall pattern that is sustainable over time. No single indicator represents overall balance perfectly. So a useful indicator, the official settlement balance, B, measures the sum of the current account balance, CA, plus the non-official financial account balance, which is FA, plus any statistical discrepancy. So B is the official settlement balance equals the current account plus the financial account balance. So this is an indicator and will indicate whether a country's balance of payments has achieved an overall pattern that is sustainable over time. Continuing, because all items in the balance of payment must sum to zero, any imbalance in the official state settlement balance must be financed through official reserves. The nations will have official reserves, and they'll use those to deal with an imbalance. B is in surplus. So if B is in surplus, and you remember what B is the official settlement balance. If the official settlement balance is in surplus, it must equal an accumulation of official reserve assets by the country or a decrease in foreign official reserve holdings of the country's assets. Okay. B, when B is in deficit, it must equal a decrease in the country's holdings of official reserves or an accumulation foreign official reserves holdings of the country's assets. Okay, so in both these cases, we're seeing both a surplus and a deficit has to do with changes in official reserves or accumulation or decrease in foreign official reserve holdings of the country's assets. So most of the transactions by the country's monetary authorities that result in changes in official reserve holdings are official intervention in foreign exchange markets. So nations will take steps that are interventions that will affect the official reserve holdings of those countries. Now moving on to the international investment position. The international investment position is a statement of the stocks of a nation's international assets and foreign liabilities. So we've got assets and liabilities at a point in time, usually at the end of the year. So this is a statement of the stocks of a nation's assets and liabilities that are international and foreign. So here we've got the U.S. international investment position at the end of selected years. We've got one clear back to 1897 and most recently 2013. You can see the U.S. investment abroad as a whole, and this is in billions, so 1.3 billion. And here we've got 22.9 trillion as of 2013 in total. And that is made up of private investment, which includes direct investment and other private investments, U.S. government non-official investment positions, and U.S. official reserve assets. So you can see all of these 5 items will make up this top item of U.S. investment abroad. Then we've got foreign investments in the United States, which tally a total in 2013 of 28 trillion. This is the direct investment in the United States, foreign investments in the United States, and here are the other foreign investments in the United States. So 23 trillion there and almost 5 trillion there. So the U.S. net international investment position is the difference between these two. Here's our investment in the U.S. abroad. So the U.S. investment abroad, and here is foreign investment in the United States. So more money has come into the U.S. through investment than has gone out. And so the net position is a negative amount of negative $5.3 trillion. Okay, so now we're going to look at a few slides in relation to the Euro crisis. Now, the Euro crisis occurred at the time of the credit crisis, specifically where we saw issues with these are the main culprits. We've got Greece, which has really struggled and a major culprit of this crisis, but we also have Portugal, Spain, and Ireland. So you can see that this is the current account balance as a percentage of these countries' GDP. So these countries' current accounts as a percentage of their GDP. So you can see Greece dropped clear down to almost negative 15% as a percentage of GDP. They were bringing in or borrowing a lot of money, and there were some major issues with Greece as well as these other countries. You can see we've seen a bit of a recovery over the last several years, but they do still struggle. Now we're going to look at the Euro crisis countries and their net international investment position as a percentage of GDP. So as we see in this figure, in 1999, when the euro was created, Greece, Spain, and Portugal all joined. They were moderate net debtors. So they were borrowers in general, but it was moderate. It was not out of hand at that point. So they had a negative net international investment position because they were debtors rather than investors. And it equaled about 30% of their GDP. So that's significant. You can see Ireland joined in 2001 with not quite as a heavy debt position as Greece, Spain, and Portugal. But for Greece, Spain, and Portugal, their position steadily deteriorated. For Ireland, you can see in 2007, as it entered into a massive banking crisis. Ireland was big in banking, and we know what happened in the credit crisis. We can see what happened. They became severely in debt as a result. So by 2009, all had negative net international investment positions between 90 and 112%. We can compare this. The net foreign debt figure shown for the United States in the book in 2017 was 40% of U.S. GDP. And we're in more debt than we have been, and so these countries were in significant trouble and problems, and it led to what we call the Euro crisis, which this is showing. So they've borrowed significant amounts of money and having difficulty paying back. So someone watching these indicators would have seen that by 2008 to 2009, these countries' negative net international investment positions had become very large relative to the size of their national economies. And with heightened sensitivity to risk from global crisis that began in 2007 and then intensified in 2008, foreign financial investors and lenders were unlikely to go on lending freely to these countries that had become so indebted. So these developments were part of the lead into the Euro crisis, where these nations had to be bailed out, especially Greece. With that, that's the end of this lecture, Payments Among Nations. I strongly encourage you to read the book and do the quiz and make sure you understand these topics. If you have any questions, please feel free to give me a call or shoot me an email. Thank you very much.